For most of your investing life, you've probably heard about the importance of asset allocation, how it's critical. And that is true until you reach retirement. And that's what we're going to talk about today on the Retirement Answer Man Show. Welcome to the show. My name is Roger Whitney. I am your host. And this is the show dedicated to helping you not just survive retirement. We're here to help you rock retirement, to make the most of this only life you have where you have a ton of time freedom. We want you to rock it. So today we're going to talk about asset allocation, and we're going to talk about how investing is different and how we allocate assets in our practice and give a framework for you to hopefully manage some of this market risk that we all worry about so much. Now, before we get started, a word about February, because we're here at the end of January. In all of February, we will be talking about long-term care, about what is long-term care, how severe is the risk and likelihood that we might have to deal with it, and then how do we actually transfer some of this risk? What are the tools available currently so we can build a framework for you to make a good decision for you? So that's going to be all of February. But before we get started, let's have a word from our sponsor. Hey, Roger Whitney here for the Rock Retirement Club. This is our online community where we have over 300 people walking life together and learning how to make the most of the only life we have. We have great people. We provide world-class education on all the steps you need to take to be able to rock retirement. And one aspect we have is what we call financial basics, very much like the What's That Mean segment, but goes a lot deeper, where every month we train on a specific topic or issue and give you the knowledge you need to be better equipped to make financial decisions. So if you're interested in world-class education on retirement, plus being able to crowdsource and share the collective wisdom of the club, go to rockretirementclub.com. Now let's go figure out what that means.
Huh? What does that mean?
Asset-liability matching. What does that mean? So asset-liability matching is the process of investing so that cash is available when you need it to cover consumption. Sounds like something that may be very important in retirement. I need to have money available for consumption. But it's interesting in retirement planning how little, if at all, we hear about asset-liability matching. So asset liability matching comes from the pension management world. So if you think of a pension, they have money coming in from contributing employees that the company is putting money in there in order to cover the payouts, the pensions of people that are currently retired and people that are coming on and retiring. So they have to be very careful in how they manage their assets. And what they do is a form of asset liability matching. They look at the assets they have and they have to make sure that they have assets available for the current pensioners to pay that out. But they also have to invest for future pensioners, that could be 10, 20, 30 years in the future. This is very similar to what you do when you retire. You have a pool of assets. You have consumption that needs to be covered on the short term, but you also have consumption that needs to be covered 10, 20, 30 years from now. That's what asset liability matching is, and that's what we're going to talk a little bit about in the show today. So in the main segment today, I want to walk through why asset allocation is not the way to invest in retirement, at least not the only way. There's more to it than that. So first off, asset allocation is that allocation pie chart. It's the idea of investing in different asset classes, stocks, bonds, international stocks. You can slice and dice it any way you want. It's that pie chart. The idea is managing what's considered unsystematic risk. By buying the market in some mass way, you're really just left with the returns of asset classes and the mix of assets that move in different directions. And that's generally how we've invested in our 401ks and in our investment accounts of let's have a 80% stock, 20% bond asset allocation. And over the long run, the averages should work out as long as I keep rebalancing. The problem is, and so that's the pie chart. So we're going to call that the pie. And very often I'll receive emails on question, what should my asset allocation be in retirement? What should my pie look like? What colors should all the pieces be? Well, here's the deal. Asset allocation works very well in accumulation. In fact, modern portfolio theory and optimization was all focused around accumulation and no real end date in sight. But when you are retiring, you're not sowing, you're not accumulating, you're getting to the reaping stage, sort of the pension stage. And if you're managing your own assets, you're basically paying out a pension to yourself for your consumption. And asset allocation doesn't solve for that. And so it doesn't work. So what should your asset allocation be in retirement is really not a complete question. So what I say is the pie is good, right? The asset allocation pie is good. But in retirement, you don't just need a pie. What you really need is a cake. Think of it like a wedding cake. And the cake has what? Different layers, right? You have the bottom layer, and then you have the next layer above, and then the next layer above. It's a cake. Just think of your normal wedding cake. But here's the deal. In retirement, those layers of the cake are actually pies. So it's a pie cake. I think it's clever, but hear me out. So each allocation has a percentage of, let's just call it bonds and stocks or cash. Each allocation has its own pie chart with a mix of bonds and stocks and cash. And depending on the layer of the cake, that pie chart is going to look different because we have to match our assets to consumption. So it's a pie cake. We're going to have a tiered level of asset allocations based on when we think we need the money. And this is essentially what asset liability matching is. So the way you go about figuring this out is you have to know, well, what are the liabilities that I have? And so in retirement, you're spending for, let's say 2021, let's say you're going to spend $100,000 in your needs, wants, and wishes in 2021. Well, that is a liability. You need $100,000 in order to pay out yourself to be able to consume. So every year in retirement, you have a liability of where you're going to need to pay money to yourself in order to fund your consumption. So step one is always figuring out your liabilities. And you're going to figure those out year by year because you're going to have some years where it'll be $100,000 in this example. You'll have other years where it'll be $200,000 because you're making a big purchase and taking some trips. And then you have some years that may be $90,000. So your first off is you want to figure out what are your liabilities year by year for the life that you want to live. And then you want to figure out, look at your assets, subtract the amounts that are going to be covered by your social capital or your human capital. And what that means in layman's terms is what percentage of those liabilities will be covered by Social Security when it kicks in, or by a pension when it kicks in, or by part-time work when it kicks in. And then the remainder of that liability that isn't covered by all that stuff has to come from your financial assets. And this is where we create the pie cake. And like with any cake, you start with the bottom layer. And the bottom layer is meant to cover near-term liabilities. In this example, 2021. So if we know we're going to need the money within 2 years, that allocation will likely be all cash because that money has to be there. And we don't have time to wait for market cycles. So it's going to be, the risk profile will be capital preservation. The objective is going to be liquidity and stable value. And potential vehicles for that are money market, CDs, stable value funds, things that will eke out a little bit of return, but will be available in 2021 for that $100,000 that we know we're going to have to spend. So that's going to be layer one of your cake. Your pie chart is going to be cash or cash-like investments. Layer two of your cake is going to be a different pie. This is going to be money that are going to fund your liabilities or your planned spending, let's say in years 3 through 6. So here, our risk profile is capital preservation, but it would be nice to earn some income. We still want stability, but we want to earn some income too because the time frame is 3 to 5 years. So this pie is going to have, it could have CDs, it could have stable value funds, it could have individual bonds that are maturing. And this is usually what we like to do is if we know we're going to say need $120,000 3 years from now from our financial assets, then we'll have something maturing right around the time the liability is due so we can fund that lifestyle for that year. And this is what we call an income floor. And this would be the second layer of the cake. And the pie chart wouldn't look like cash because we're investing in some things, but we're still near term. Those liabilities aren't that far away. And so we're going to fund it with the types of things we talked about. Now, the third layer of the cake, so now we're starting to build up. The third layer of the cake is going to have a very different looking pie that makes it up. This is going to be what maybe we would consider a long-term core portfolio. This portfolio is going to have a time frame of 6 to 10 years. Its risk profile is going to be moderate. Its objective is going to be growth, but income, so more balanced. And the flavors or the ingredients that are going to make up this layer will include bonds, may include real estate, may include equities. Because this one has a time frame of 6 to 10 years, it's going to be more of a balanced portfolio because we're trying to get some growth here and still some income. So it's not going to look like cash. It's not going to look like bonds. It's going to be a mixture of a lot of things. And for some, a 3-layered cake like this might be enough. But the fourth layer, if you want to go skyscraper, this is going to have an investment frame of 10 plus, 15 year plus time frame. So here, the risk profile is probably going to be really aggressive. This is going to be growth oriented. So it's going to have even more of the ingredient of equities and risk type assets and less of bonds and cash, because this is money that we're not going to need for 15 years theoretically. And so you can see we've built a cake, and each layer is a pie that's focused on its purpose. Because what the central issue that you're dealing with in retirement is you want to fund your life. And then you have two competing interests of today, you can't lose principal for what you're going to spend this year or next year because you don't have time to make it up. So you have loss of principal as the real big risk today, that sequence of return stuff. The problem is at the other end, you have loss of purchasing power in being able to fund your life 10, 20, 30 years from now. And inflation is your biggest risk then. So you have to find some balance between those two risks. And asset allocation by itself doesn't do the job. It's not meant to do the job because it's time bound. And so creating different asset allocations in a tiered function, doing asset liability matching, creating a pie cake, allows you to have your pie and eat your cake too. And so this is the method we use in our practice and the one that we talk about and train on in the Rock Retirement Club. So there's something for you to think about when you're thinking about what your allocation should be for retirement. With that, let's go on to a conversation with our retirement coach in the club, BW, on some coaching tips on how to handle volatility and retirement. So as we do at the end of every month and every theme that we talk about, we bring on the retirement coach of the Rock Retirement Club, BW. BW, how are you doing today?
Doing great, Roger.
BW and I have a wonderful relationship. One thing I love about BW is, well, obviously he's wicked smart and he has a kind heart, but he doesn't pull punches, which I think is awesome. That's a great way to learn when you can combine those three things together. And there's a lot of punches being thrown when you're in the midst of a bear market, BW. So what do you have for us today? How do we handle that?
Well, Roger, when I saw your topic for the month, surviving bear markets and market crashes, I really think it's two different topics because I think the best way to survive a bear market is through having a good plan in place and understanding your plan and having confidence in your plan. The best way to weather a market crash is to do nothing, is to stay the course. And too many people panic and sell. Research shows us that the way most investors behave is during good markets, bull markets, they get more confident as those markets keep going up and they increase their equity holdings and they get too much in equities. And then when the crash and the fall happens, they panic and they sell after the market's dropped. And then what do? They sit on the sidelines for too long when the market starts to recover. And so they miss most of the rise after a bear market. And so the best thing to do is to have a plan, understand how much risk you're taking, then just to live with that plan.
It sounds so simple. And you're right. We threw that in there, but there's nothing you can do when your house is on fire, when it's burning. You're just going to have to wait for the fire department and wait it out. But it's so traumatic. But you're right. Bear markets, you're prepared for a bear market well before it comes.
Exactly.
Right.
Exactly. If you're nearing retirement or in retirement, hopefully you've got a retirement income plan. You've stress tested that plan. You understand that while a market crash might be 50, 60% fall, you're not going to be 100% in the market, in the stock market. So you're not going to fall 50 or 60%. You need to understand that through the stress testing.
What's interesting about that, BW, though, is, and I remember going through this, is even if, like, let's take '08, even if you had relatively conservative or moderate portfolios, you're still down 25%, right?
And that's not easy to take, is it?
Well, yeah. And we talk in percentages a lot of times. 25% of $1 million is $250,000. That's hard to see, isn't it?
It sure is. And it's tough to watch it. And this is where I think one thing you can do to protect yourself is to educate yourself about bear markets and how long they tend to last. And if we look historically, they really don't last that long on average. And even during the Great Depression, while that's the longest one that we've recorded so far, it wasn't that long if you had a plan that protected you with a couple years or more of cash to survive that, so that you're not having to sell when the market's at its bottom. And
in this idea of
that's all through planning and knowledge.
And I think this idea of pessimism and optimism sort of go hand in hand with bear markets and good times, right? And
absolutely.
And I think it doesn't just permeate how we invest, it permeates the car choices, the places we eat out, the homes we buy. In good times, we tend to feel flush and sometimes obligate us to payments that are still there when we're not so optimistic.
Yeah, you're so right. We make our lifestyle so much higher in the good times. And then when the bad times come, it's harder, isn't it?
Yeah, then everything goes on eBay.
And investing, unfortunately, our human biases and instincts often lead us astray. They tell us to do exactly the opposite that we should do. I mean, when people are more fearful and the market looks at its worst, that's the time to buy. That's when it's down. And yet our instincts are to do the opposite.
The media feeds our instincts.
Oh, yes.
Right?
Oh, yes. They love those clicks.
I saw a presentation once, and it was related to a magazine cover, so it's a little dated, right? But it showed all these captains of the universe and optimistic headlines during good times, and then went through a bad period. It was virtually the same people on there as these scoundrels and, people that we should never listen to. The media just sort of reflects and magnifies what we're feeling.
You know how we have these fact-checking organizations for our politicians? I want to see that for the market prognosticators. I want to see, hey, here's how this person did over the last 20 years with their projections for the future.
Well, there's just a need for that. I think it's a human need to have find someone that knows in there.
Yeah. And, this is an area where I think the individual, knowing yourself is really important. If you don't trust yourself to remain calm during a bad market, you need to find a good planner that you trust that can help you, make good decisions when the market falls like that.
You teed that up, so I'm not going to not hit it, but it was not intentional, or a good group of people like in the Rock Retirement Club that you can help center you.
Absolutely. I hate those risk tolerance questionnaires that a lot of people find on websites that they use to determine risk tolerance. I just think those things, I've taken them myself and they're just not true. When you're answering 10 questions on a web form about what you'll do if something happens is not a very good indication of what you'll do when something happens.
Well, and what you'll do is very flexible based on, again, that pessimism and optimism, right? My risk tolerance is much higher when I'm optimistic and on my toes, and then rather than when I'm on my heels. And this is one reason why, and I had a comment, BW, on this series of, what? You're doing something on bear markets? The markets have been great. We just set records. I'm like, yes, that's the time you do it.
Exactly.
I probably won't get as many listeners as I would if I did this during bad times, but that's the point. Right.
And I heard you make a comment on one of your earlier podcasts, Roger, about you have clients that still have not gotten back in the market fully since the 2008 fall. And as we know, in looking at it in hindsight now, that lasted about 18 or 20 months?
I think of it as a slow rolling crash more than a bear market.
Yeah. But the recovery was pretty fast out of it, right?
Yeah. When they turned the spigots on of monetary easing, everybody underestimated. Because if you remember in 2009, after 8, and it wasn't just the markets going down, but it was the media and what was happening, Bear Stearns, Lehman Brothers. Sure. 2009, that first quarter was down 26% and ended up the year up about 25%. So that was
exactly. You didn't have much time to get back in if you jumped out near the bottom, and then you missed a lot of the recovery.
Yeah. So what do we do with all of this? You said if you know yourself, potentially have an advisor or somebody, but what are some other things do you think that you can do internally to help you with this?
Yeah, well, I think when the market starts, it's falling, and as you say, the headlines and the media start spinning out the reports, the best thing to do is to turn them off. Don't read it. Don't watch it. Go take a yoga class. You'll be healthier and your investment portfolio will do much better. I think for a bear market, though, these are real and they can last several years. You have to go back and reevaluate your plan. And maybe what you need to do is cut your spending a little bit. Maybe you need to postpone some of those large capital expenses that you were planning. Maybe you need to take on a part-time or seasonal job if you're retired. When life changes, you need to be flexible and change with it. But if you had a good plan up front and anticipated the bear markets, which a good plan does, then you should be pretty good.
It's interesting, and I think those actionable things are really important because even if you have the plan and the cash flow cushions to anticipate riding through these type of things, which are the things that, we talk about, building income floors and guaranteed income streams. It's interesting. It still helps to be able to make choices on your spending habits or earning some income, even if they don't make a difference in the whole plan, right? Because intellectually, we need that. We need to say, I am doing something. Exactly.
Yes.
As always, BW, you are very wise, and I appreciate you coming on here and in the club.
Good to talk to you.
On your marks, get set.
And we're off to set a little baby step that we can take in the next 7 days to rock not just retirement, but life in general. So, hey, Nicole, why are you giggling at me?
You sound very serious about rocking life.
Well, we say this every week, which is awesome. And I guess it should be uniform. And we could probably pre-record it, but come on, it's fun.
No, let's not do that.
You got to jazz things up. We got to take our jazz hands out and shake them every now and then.
Okay.
All right. So in the next 7 days, we're ending this series on market crashes and bear markets and retirement. So in the next 7 days, I want you to maybe re-listen to the pie cake analogy and start to look at your net worth statement and your investment allocations from this tiered approach. Because I think this is a big change in lens that we're taking in retirement, because we've always thought of things as just an allocation when really it's a cake made of different allocations, different pies, like we talked about. So I think it's really important that we grasp this concept, because in retirement, we're going to want to allocate our assets based on time segmentation using these tiers. And it's important we understand that. And honestly, in the advice industry, I don't think a lot of people do when it comes to retirement. So re-listen to that. And
how close to retirement should you be to be thinking about this? You're still 10 years out. Is that too?
I think that's too far. I think when you start to get within 5 years, you want to start modeling what these tiers should look like. And then when you start to get within 3 years, you want to start building the tiers. Like a good example is in 5 years, you want to start building that cash reserve tier, that foundational tier, because you'll have a lot of time to start maybe redirecting savings towards that first liquidity tier that's going to help fund those early years. So that's a great question. So you're off.
I'm here to help.
You're here. You always. So Nicole, next month is February. Did you know that? Comes after January every year.
That is what comes after January.
And so at the end of the show, we never really know how to end the show. Just, hey, thanks for listening and all that. So what I thought we'd do is at the end of the show, just share random feedback and comments that we get from listeners. We get a lot of them.
Oh, yeah, that's a good idea. I like that.
Even in questions, we get, sort of a little feedback segment of their question, commenting us on our chemistry, like we heard the other week. And sometimes.
So when are we going to do the all important disclaimer part? Is that like the real end?
Yeah, we'll just call that the real end. That's the real end.
Okay.
Good point. Yeah, so that'll be the real end, which I know a lot of people, we got great feedback on that, by the way.
I had really strong feelings about the disclaimer.
People were indifferent or very strong. It was not a lot of in between.
Mm-hmm.
Every now and then I may move it back up front just for kicks. But
so we can get feedback emails to share at the end about how they don't like it.
It's like when my wife tells me to stop poking her. Every now and then I just got to poke her again. But we're going to use this segment to share your feedback. So if you don't have a question and you just want to share some love, which we love, or if you want to share some suggestions to make the show better, we'll share it publicly. We're always improving. And with that, let's go to the all-important disclaimer. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.